Click the bell icon to get latest videos from Ekeeda.
Now we learn how to prepare vertical balance sheet suitable for analysis. Normal balance sheet is prepared in horizontal format where it has got two sides. First part is called as liabilities and second part is called as assets. For management accounting purpose, when we require to analyze financial statements of business, that is income statement and balance sheet, we require to convert them from horizontal to vertical format. How to prepare this unique vertical format, how to arrange the items, how to group the items, that we are required to understand first. Let us look at the vertical balance sheet. Heading will be same that of horizontal balance sheet. We are required to give heading vertical balance sheet as on, for example, 31st March 2019. First part of the balance sheet is sources of funds. In horizontal balance sheet, we have two sides, liabilities and assets. In vertical balance sheet, we have two parts. First part is called as sources of funds. Second part is called as application of funds. In simple terms, first part shows how money is received in the business, and the second part shows how money is used in the business. Both the parts should tally. That is what the agreement of sources of funds and application of funds. In sources of funds, we have basically two items. One is owner's fund and other is called as borrowed fund. Owner means proprietor's fund. Here we'll have to first consider capital. It may be equity capital, preference share capital. In case of proprietor's business, proprietor's capital. In case of partnership, partner's capital. In capital of company, we'll have equity share capital, preference share capital. Any call scenarios are there, we are required to deduct. In case of proprietor's capital, we are required to deduct drawings. We have to add forfeited shares amount or any additional capital brought by the proprietor or partner during the current year. Next item comes reserves and surplus, that is retained earnings like capital reserve, capital redemption reserve, share premium, general reserve, other reserves, profit and loss account credit balance, that is surplus, sinking fund, other funds, minus funds which are invested. From this we are required to deduct fictitious assets, that is the assets which cannot be realized. For example, profit and loss account debit balance, miscellaneous expenditure group items which are not written off, like we have preliminary expenses, discount on shares and debentures, redemption premium, share issue expenses, underwriter's commission, etc. It can be called as net reserves and surplus, which is added to share capital to arrive at shareholders fund. So own funds, which is also called as net worth, is capital plus reserves and surplus minus losses and fictitious assets. The second part is loan funds or borrowed funds. It can be secured loan and unsecured loans. Secured loans are those loans against which we have provided some security of assets. For example, in case of debentures, loans from bank, loan from financial institutions, those are taken by mortgaging some fixed assets, like for example land and building, plant machinery. These are mortgaged and against this we take a loan. So this comes under secured loan. Next, unsecured loans, like we have public deposits, loans from directors, etc., where we have not provided any security, unsecured loans. So total borrowed fund will be comprising of secured loans and unsecured loans. Then the first part of the balance sheet is shareholders fund plus borrowed fund, own fund plus borrowed fund. This will be first part of the balance sheet. Second part of the balance sheet is application of funds. In application of funds, We have first fixed assets, tangible, land and building, leaseholds, plant and machinery, furniture and fittings, vehicles. If any cost is given from which we are required to deduct depreciation to arrive at WDV. Then intangible fixed assets like we have goodwill, patents, trademarks, designs, etc. Tangible plus intangible, we will be getting total fixed assets. To this we are required to add long-term investments. That may be investment in government securities, shares, debentures, less any sinking fund for such investments, investment in immovable properties, investment in capital of partnership firms, long-term loans given, that will be part of long-term investments. Last part is working capital. In working capital we have first current assets. There will be two types of current assets. Quick assets, which can be quickly converted into cash within short period. Cash and bank balance, net debtors, trade receivables, bills receivables, short-term loans and advances given, accrued income, short-term or marketable investments, total or liquid assets. Then we have non-quick assets or non-liquid current assets. Inventory means stock of work in progress, stock of raw materials, stock of finished goods. Prepayments, prepaid expenses, advance for goods, advance tax, etc. These amounts are current assets, but these cannot realize cash very fast within short period. Therefore, those are referred as what? Non-quick. Thus, we get total current assets, that is quick plus non-quick. From this, we are required to deduct current liabilities, which are of two categories: quick liabilities and non-quick liabilities. Current liabilities which are required to be paid within a short period or within a period of 1 year are referred as quick current liabilities. Creditors, trade payables, bills payable, advance received, outstanding expenses, accrued interest, provision for tax, unclaimed dividend, proposed dividend, short-term loans. To this we are required to add non-quick liabilities, that is bank overdraft and income received in advance, which are not required to be paid within a short period of time. For example, bank overdraft is an arrangement with the bank which business is not required to repay immediately. Thus we get total current liabilities by adding quick and non-quick current liabilities. Thus we can arrive at total current liabilities by adding quick and non-quick current liabilities. Thus by adding fixed assets, long-term investments and working capital, we arrive at total assets or total funds employed. Current asset minus current liabilities will be getting working capital. Second part of the balance sheet is consisting of fixed asset plus long-term investment plus working capital, that is current asset minus current liabilities. Thus a vertical analytical balance sheet differs from horizontal balance sheet in following respect. Current liabilities are deducted from current assets. Fictitious assets are deducted from the owner's fund. This should be kept in mind while converting horizontal balance sheet into vertical balance sheet. At times, application of funds is shown first, followed by sources of funds. So there can be what? Interchanging of first part and the second part of the balance sheet as discussed. Explanation, main heading. The vertical form has got two parts. Part 1 is sources of funds and part 2 is application of funds. Source of funds. A concern has two main sources of funds, own funds and loan funds, as discussed now. Proprietors or own funds. Proprietors or own funds or internal sources means capital of the owners, proprietor, partners or shareholders, and retained earnings or reserves and surplus. To arrive at net worth or owner's fund, capital and reserves are added and the accumulated losses, that is miscellaneous expenditure group items which are not written off, fictitious assets are deducted. The accumulated losses, that is profit and loss account debit balance, and fictitious asset like miscellaneous expenditure not written off, reduce the amount of funds available or attributable to the owners, and hence have to be deducted to ascertain the owner's net worth. Next, borrowed or loan funds. Borrowed or loan funds, long-term borrowings, constitute another major source of funds. Loan funds may be secured loans like debentures, bonds, loan from banks, loan from financial institutions, or unsecured loan like public deposits. The total secured and unsecured loan gives the total amount of loan funds or owed funds of the business. Total funds available. The total of own funds and owed funds is the total amount of funds available to the concern as on date of balance sheet. How these funds were actually employed and used is shown in the second part of vertical balance sheet, that is application of funds. The total funds available are used to finance fixed assets, net current assets, that is working capital. Fixed assets. The fixed assets, which are also known as non-current assets, may be classified as tangible and intangible. Tangible assets have definite physical existence. Tangible means that which can be touched. Thus, land and building, machinery, vehicle are tangible fixed assets. These are shown at net cost, that is cost minus accumulated depreciation. Intangible assets cannot be seen or touched but do earn income for the concern like goodwill, trademark, patents, designs, etc. Net fixed asset means fixed asset less accumulated depreciation thereon till the date. Long-term or trade investments. Long-term or trade investments are those investments which are intended to be held for a long term, such as investment in immovable properties, or those which are held in normal course of business. Example, investment in capital of partnership firm. Investment in government securities, shares, bonds, etc. may be long term or short term depending upon the circumstances. Capital asset means assets including investment not held for sale, conversion or consumption in ordinary course of business as per CA Institute's guidance notes. Next comes working capital, is represented by excess of current assets over current liabilities including short-term loans. It means funds available for conducting the day-to-day operations of the enterprise. Current assets. Investment in fixed asset is a permanent or long-term investment. A concern also has circulating funds, that is short-term asset like stock, debtor, etc. called as current assets. These assets keep getting converted into cash. Those current assets which can be quickly converted into cash are called as liquid or quick assets. Current liabilities, on the other hand, are short-term liabilities payable within a year. These arise out of purchase of goods on credit, outstanding expenses. The excess of current asset over current liability is called as net current asset or working capital. Total funds or capital employed. Capital employed means the finances developed by the enterprise in its net fixed assets, investment and working capital. The amount of total funds used or employed is equal to net fixed asset plus working capital. Vertical balance sheet structure can be analyzed through the following equation. Own funds plus loan funds is equal to fixed asset plus investment plus working capital. Total assets is equal to fixed asset plus investment plus current assets. Total liability is equal to owner's fund plus borrowed funds, etc. Thus, we have understood how to prepare vertical balance sheet, what are the items to be included, how to be grouped, what headings should be put, how it has to be classified. Thanks for watching this video. Stay in tune with Ekeeda and subscribe to our channel Ekeeda. Thank you.